Happy New Year, everybody. This is Dr. Jeff Camarda with a word from Jeff entitled, The Bear Market Beckons. Now, as I wrote this Christmas Day, the markets had suffered one of their worst short-term periods since 2011, with many media pundits comparing the rout to 2008, which in many ways is the worst bear market since the Great Depression. Many are asking or wondering, are we headed into the pit again? I, for one, don't think so, and rather believe that the worst may be over, and that we're nearing the bottom for this cycle, and that it's an excellent time to buy quality stocks that are trading at bargain bin prices, which I continue to do personally with every nickel that I can muster. And again, I wrote this before this nice market pop we've had post-Christmas Eve, which was really a vicious trading day. Now, I'll get deeper into my reasons for optimisms in an upcoming video next week or so. But for now, it's important to discuss why I've personally remained fully invested through the carnage and why we've counseled clients to do the same. As many readers and viewers of this material will no doubt remember, I've been expecting a sharp correction for some time now, and sure enough, here we are. Many of you will ask, why do we not advise you to get out of it? There are two primary reasons, which are both so important that I'd ask you to make an effort to remember them for the rest of your life and to teach your children and others that you care about. Reason number one, risks of getting timing wrong are too great. Timing the market effectively is so difficult as to be impossible on a consistent enough basis to outperform the markets over time. Even really smart people with the best resources have not been shown to do it reliably. I certainly make no claim of such an ability, and the costs of getting timing wrong, and it's almost certain to be got wrong if you play long enough, just like the tables in Vegas, they so far outweigh the scant long-term benefits of getting it right that you should never consider timing or trust those that claim that they know how. Getting out at the wrong time and missing huge upsides, or buying at the wrong time only to see values plunge before selling at the bottom, are both mistakes that humans are unfortunately very hardwired to make if they let themselves play the timing game. In the end, it's much better, simpler, and more profitable to simply soldier through the slumps, keeping point number two in mind. And point number two is you must invest for your lifetime, not next Tuesday. Your portfolio strategy should be based on your personal time frame and investment horizon and consumption expectations. Think of investing as the storage of wealth. The longer you expect to store it before spending most of it, the better it will grow and the more risk you'll take. Again, the longer that you expect to store it before you spend it, the better it will grow, the more risk that you take. Over time, the more risk you take, the higher return you should expect to make. And when we talk about risk, we mean market volatility. They're not really the odds of losing money per se, but the odds that it will be less valuable in the short term than the longer term, right? So it could be low next Tuesday. The odds of that are crapshoot, probably 50-50. The odds of it being low in 15 years are almost zero. And the odds of making money over a 15-year time frame approach certainty. That's what I'm talking about. So even if you're 70 years old, if you have a normal life expectancy, your investment horizon is still 15 years or so. If you expect to consume the entire portfolio over your life, spend it all in the next 15 years, stocks should still have a significant presence in your portfolio if you want to have any real return after taxes and inflation. If the time frame is longer, or if you expect to have a good portion of the portfolio left to your heirs, stocks should comprise the majority or the entirety of the portfolio. Yes, they will go up and down, scarily at times like now, but in the end, the odds are overwhelming that you'll make more than in the alternatives if you manage to hang on to the stocks. Again, the odds are overwhelming that if you stay invested in stocks, you'll make more over time than the alternatives like cash or bonds or whatever. There are some sage adages that really bear repeating at a time like this, some really timeless sayings, kernels of wisdom. One of them is the biggest risk in stocks is not being scared out of them. Biggest risk in stocks is to not get scared out of them and sell at the wrong time because you're scared. Or another, Warren Buffettism, the time to be greedy, like I am now, is when others are fearful. Or another one, stocks are the only thing that no one wants to buy when they go on sale. But you should. Again, I recognize this is a very, very frightening time. My advice is to not participate in the fear. I know this is hard because humans are very hardwired to react in this way. It's baked in by millions of years of evolution. We really can't help ourselves. But try to overcome this instinctual fear and appreciate that this is very normal market behavior. From down the road in the rearview mirror, what seems like the end of the world now will reveal its true nature as just a bump, another bump in a long and winding road. 2008 felt and was much, much worse, but those with the gumption to stick with stocks were handsomely rewarded, double the money and more in that time frame, just a handful of years later. Try to stay strong, try to stay confident, and not look at the statements in the markets every day. Look way down the field. I think you'll be richer and happier. And again, happy New Year. Till next time, this is Dr. Jeff Camarda. Thanks for watching.